In this lesson, we're going to finish up with our calculation of some of the additional balance sheet items that we needed to create in the course of this merger model. Now, we saw over the previous few videos that we needed to create goodwill and some of these other items here because when we go and buy a company like this, oftentimes the purchase price that we pay is significantly different from the company's book value. And so that's why we needed these items to plug the hole and make sure that both sides of the balance sheet actually balance for the combined company. We then looked at how we actually calculate these items, how we figure out what kind of PP&E write-up, what kind of intangible asset write-up we have, and then we went to our balance sheet and we actually reflected the changes on there and we made sure that our balance sheet here actually balances. So as the final step in this process, the last thing we need to do here is determine what the impact of each of these items will be on the combined company's income statement. So if you think about what we've done before on the income statement, just scrolling down here, we saw how basically all we do is combine the company's line items, revenue, cost of goods sold, operating expenses, and so on. And then we factor in synergies from revenue right here, and then OPEX synergies here. And then in terms of the other effects on the company, we have foregone interest on cash, interest paid on new debt, and then we have a change in the share count depending on how they've purchased the company. So what we need to do now is take into account the effect of these new balance sheet items that have been created. So if you think about the new items here, it's basically four things. We have a change to our PP&E number, we have a change to our intangible asset number, the deferred tax liability is going away completely, so that doesn't really count as a new addition. We have a new deferred tax liability, and then we have goodwill right here. So how this works is that generally with goodwill, you assume it stays constant on the balance sheet unless there's some kind of impairment charge, and that's the assumption that we're going to be using throughout. So we're going to assume that the goodwill does not change at all. Since it doesn't change, we have no impairment charges on the income statement, and we don't need to reflect anything on the income statement. And that's just a standard assumption for merger models. Unless you have a specific reason to believe otherwise, usually you assume no changes to goodwill and that there's no effect on the income statement. For the deferred tax liability, this one can actually change on the balance sheet depending on the company's cash flows and how much in taxes they're paying, but it doesn't really have an impact on the income statement. So even if the deferred tax liability changes somehow, it's not going to be reflected on the income statement. It's more the type of item where changes from elsewhere flow into the deferred tax liability, but we don't actually reflect changes in it on the income statement. The write-down of the existing DTL we don't have to worry about. And then the last two here, so PP&E and intangibles. So remember that with any kind of PP&E, we have depreciation, and it's no exception here. We need to take into account the new depreciation on this write-up of PP&E. So we're assuming that we have added value here, and we need to depreciate that value over 8 years in this case. We know from all the accounting tutorials that depreciation shows up on the income statement, and it's factored into the operating income number. It's counted as an expense before you get to operating income, so we need to factor this in. The other thing we need to do here is take into account the amortization of intangibles. So we have around 7 billion of new intangible assets getting created, and the standard assumption is that we amortize them over 5 years. So this one's actually going to add a significant expense to the company, and so we need to take into account both of these. Now, the reason that we assume that intangible assets amortize, whereas goodwill stays the same, is that generally intangibles correspond to intangible assets that have a fixed lifespan, whereas goodwill corresponds more to assets that will still be valuable for many, many years to come. So intangible assets have more of a fixed lifespan compared to goodwill. So to actually make this calculation now, let's scroll down to the combined income statement. So for the depreciation of the PP&E write-up, so for this one, we're going to go up to our calculations right here. We're going to take the write-up amount, anchor that, and then divide by the depreciation period of 8 years here. So we see it comes out to around 22 each year. And I'm going to list it for years 1 and 2 here. So we have that. And then for the amortization of new intangibles, we're going to take a similar approach and go up to the intangible asset write-up amount right here, and then divide by the amortization period of 5 years. So we have that. and we'll copy it across for year 2. So now we have to modify the operating income formula to take into account both of these. So what we're going to do here is just add these to our formula right here and subtract the depreciation of the PP&E write-up, so E76. And then for the amortization of new intangibles, we're also going to subtract that, so minus E78 right there. Copy that to year 2. We see that, as expected, our accretion dilution here has fallen by a significant amount. So if you remember previously, it was around 15% and 17%, but with the intangible amortization especially, it falls to around 6% and 9%. So whenever you have either of these, the depreciation of an asset write-up or amortization of intangibles, they're both always going to decrease your accretion dilution and result in more dilution in a model like this. Sometimes the decrease is actually so large, which is sort of the case here. Sometimes it's so large that you actually look at it on a pro forma basis and you take out amortization of intangibles altogether when you're making this calculation. So that's something that we could potentially do here as well. I'm not going to worry about it because, again, you're not going to get questions on that type of thing in interviews, but that is something that sometimes you see at real banks. Sometimes they'll create a standard GAAP, generally accepted accounting principles number, and then a pro forma number for some of these calculations. But with that done, we are pretty much at the end of how we combine the company's balance sheets and then how we create these new items like goodwill, intangibles, PP&E write-up, and then how we properly reflect them on the company's income statement and on their balance sheet as well. So with that in place, now you know how to combine the balance sheets for two companies and why items like goodwill, intangibles, and deferred tax liabilities actually get created. Coming up next, we're going to move into the next step of our merger model and the next advanced topic, which is to look at sensitivity tables and do an analysis to see how the company's purchase price and revenue synergies and expense synergies will affect the final accretion dilution number here.